Howdy, Jacob here. Today we're doing an analysis on definitive healthcare in the healthcare technology equipment industry. 502 million market cap on 441 million enterprise value. They provide software as a service, healthcare commercial intelligence, founded in 2011. Very recent company, but you're looking at big growth. Year-over-year revenue growth has declined to 13%. Still very massive, but down from 40% year over year and 34% year over year the past 2 years. Massive gross margins of 80 plus percent. And they're still trying to figure out how to make some money on the operating margin side. We do see that they do spend 15 to 20% of revenue in R&D. Again, that's taking money away from today to hopefully make more in the future, hopefully be more efficient in the future. And not all the time it's a great investment, but that makes sense to me. While their operating margin is down, or they don't have a positive operating margin and net income. Their balance sheet shows 131 million in cash, 177 million in short-term investments, 14 million short-term debt, 243 million long-term debt. So in all of their cash-like products, they can pay off that debt. Obviously, short-term investments aren't the quickest way to pay off debt, but not bad to have that. We're not concerned with this balance sheet as long as they make some money on the cash flow statement, and we see that they do. So heavy depreciation and amortization in relation to their capital expenditures. So their depreciation and amortization are 50, 60 million with capex under 10 million. So that's why they've been able to produce some solid free cash flow, and they've been reinvesting, making acquisitions, and it looks like they did pay a dividend over here, maybe where they were just some one-time dividends. They have reduced debt over here as well, but it looks like most of their money is going to be going towards acquisition and reinvestment to keep their growth. So I'm going to stick with that for a lot of these assumptions. So I'm going to have about 10 to 15% go to debt reduction because although they have a lot of cash, although they have more cash on hand than debt, I do want them to focus a little bit on reducing that debt. And I think I'm fine with that presumption. It's pretty low. This is keeping about a 70% to acquisition reinvestment to get a 10% rate of return. And although it's not all organically, they are reinvesting quite a bit. So I think an 18 P seems to make sense to me. That's quite a bit above market. I don't think they have a dominance yet, so that's dampening their PE, but their growth is definitely well in advance. And so I'm keeping that. We're going to say that their earnings margin grows to almost their free cash flow growth or their free cash flow margin, but they are issuing shares through stock-based compensation, 50 million shares through stock-based compensation on a $500 million market cap. That's going to be about 10%. So that's going to dampen their present value quite a bit if you wouldn't take shares into consideration. I know a lot of models don't, but for me, that's part of capital allocation. So I do like to take it into consideration whether they're buying back shares or issuing shares, likely through stock-based compensation. So for me right now, it has to fall 65% to get to the return we're looking for here. I think if they dampen the share issuance or option issuance through share-based compensation, then their free cash flow goes lower. So there's kind of a balance there of your margins going lower with keeping those issuance of shares. And I know that companies and CEOs, CFOs enjoy those compensation benefits to get part ownership of the business that they're running. But I mean, for me right now, given all the numbers that I'm seeing, I'm definitely going to have to wait a little bit, even though I do think there's a lot of growth for this company. It's just not the right price for me. Thank you. Have a great day.